there's always that fine line between persistence and stubbornness. And the way we try to stay on the right side of the line is with our group decision-making process. You have lots of points of view around the table. So we have a diversity of opinion and a diversity of perspective. So that helps keep us objective. And we have two other tools that we deploy. One is we have a devil's advocate that we bring in. An analyst will select from our team to present the other point of view. That helps us refresh our thinking. And we have what we call an all-cash exercise. That is literally the investment team getting out a blank sheet of paper and investing to 100%, which we then compare to how we're actually investing. And that's a terrific way to also keep our thinking fresh and current. A value trap is usually, in someone's mind, a stock whose price has not gone up in a very long time. What we want to distinguish between are companies that are mispriced and just require a lot more patience, and companies that, even though they're cheap, are fairly priced because their business is eroding through technological disruption or management inattention, for example. And so starting with thorough fundamental research is one very key ingredient of avoiding a value trap. We think having investment experience and judgment at the table, we've learned some of these the hard way, can help us distinguish between the two. And I would also offer, because they are hard to determine ex ante, that investors are typically better off owning a portfolio of inexpensive companies, even if some of them turn out to be value traps. Macro considerations are an important part of our analysis. We work very closely, our equity and fixed income teams together, and we have a macro strategist on our fixed income team who is essential to our global bond effort, who helps us understand some of the key drivers in the economies where the companies we're looking at operate. But that's an input into our thinking, not a top-down view of where we should invest. In fact, guided by valuation, it's oftentimes the case, because markets are forward-looking, that the best time to invest in an area is when the current conditions are the worst. We cover the global universe from San Francisco because our process really rests on a lot of collaboration and interaction among our investment team. We have a very discussion-intensive process. Because of our low turnover and because of the intellectual capital we've built over decades, we are pretty selective in being out and about in the world to visit companies, meet with their managements, see their key facilities, and evaluate opportunity.